Welcome to the Deep Dive. Today we're doing an in-depth exploration of the Korn Ferry Q2 Fiscal 26 earnings call.
And what a call it was. The stock, KFY, jumped 4% on the release.
On double the normal volume, too.
Exactly. So our mission today is pretty straightforward. Figure out why the market reacted so well. We need to get into the strategy, the new tech, and, just how much visibility they really have.
Right. So let's start with the top-line numbers because they really set the stage. KFY released a pretty clear beat across the board.
A very clear beat.
Total revenue came in at $729.8 million. That's almost $25 million above what consensus is looking for.
And it represents a healthy 7% growth year over year, but, the top line is only half the story.
It's the bottom line leverage that really caught my eye. Adjusted earnings per share hit $1.33.
Beating the street's expectation of $1.30. And here's the crucial part. Adjusted EPS grew 10% year over year.
Which outpaced that 7% revenue growth.
Right, and that 3-point gap, that's the whole story, isn't it?
It tells you the growth is high quality. It's falling through to the bottom line more efficiently.
It's proof of strong margin control. I mean, their adjusted EBITDA was up 7%, holding a really solid 17.3% margin.
And the net margin improved 100 basis points.
A full percentage point. In this kind of environment, that shows some really powerful execution.
Okay, so let's unpack the strategic narrative here. Management kept hammering this idea of we are Korn Ferry.
This is the absolute center of the bull case, I think. For years, the market saw KFY as, 5 separate businesses.
Search, consulting, RPO, all kind of doing their own thing.
Exactly. But now the integration strategy is really starting to work. You can see it in the numbers.
So how do we measure that? What's the key metric?
It's cross-solution revenue. It hit 27.6% of total fee revenue this quarter.
Which is up 2.5 percentage points from last year.
Right. And their long-term goal is 35%. So this is real measurable progress. It shows they're changing how they sell.
And they gave that fantastic anecdote to illustrate it. The major real estate firm building AI data centers.
That's the perfect example. It was a massive deal that included a huge RPO contract for hundreds of hires.
And a total rewards and consulting contract for the whole new division.
Exactly. One entry point leads to a multi-year, multi-solution relationship. That's how you create client stickiness. You become much harder to replace.
Okay, let's dive into the segments then, because we need to see what drove that 7% beat. Executive search was a monster.
Just a powerhouse. And it's what they're known for, right? Fee revenue was up 10% year over year.
And that's the 6th consecutive quarter of growth.
Right. And management points to 2 big macro tailwinds here. First is just a structural need for new leadership skills.
Companies need different people at the top now.
For sure. And second is demographics. That peak 65 retirement wave is real, and it's forcing leadership transitions across the board.
So pretty durable demand floor there. What about professional search and interim? That was up 17%.
A huge jump. But we have to put a little asterisk here.
The Trilogy International acquisition.
Exactly. That boosted the numbers, but management was clear that even if you strip that out, the underlying business is still accelerating.
Okay, that's the important part.
Interim services specifically were up 24% sequentially. And look at the bill rate, $142 an hour.
Wow.
That tells you clients are paying for high-quality, immediate expertise, not just, warm bodies.
And the RPO business, recruitment process outsourcing, also looked really strong for future work.
Very strong. They booked $253 million in new contract value.
For those not familiar, that's where a company basically outsources its entire hiring function to Korn Ferry.
Right. And the breakdown of that new business tells you everything. A huge 84% of it came from renewals.
So phenomenal client retention.
It just shows that once you're in, the service is deeply embedded and really hard to rip out.
Okay, let's turn to consulting. The growth here was a bit more modest, right? Plus 4%.
It was. But this is a classic quality over quantity story. The real news is hidden.
In the bill rates.
Exactly. Average bill rates were up a massive 10% year over year to $460 an hour. They are absolutely moving up the value chain.
And what does that mean in practice?
It means they're moving from small projects, what management called selling vitamins, to these huge integrated health and wellness transformation projects.
Advising a CEO on fundamental org strategy.
Right. And you command a premium for that. And the data backs it up. Engagements over $500,000 are now 40% of their new consulting business.
Up from 37% last quarter.
It's a measurable shift. They're winning bigger, more impactful deals, which all ties back to that We Are Korn Ferry strategy.
And that durability, that's what gives them this incredible forward visibility.
This is where it gets really interesting for an investor. Their backlog, the estimated remaining fees under existing contracts, surged 20% year over year.
To an all-time record of $1.842 billion.
Just think about that number for a human capital business. It's an insane level of certainty. And they expect about $1.05 billion of that to turn into revenue in the next 12 months.
That is a massive buffer against any, macro choppiness.
It's a huge operational floor.
So, okay, if consulting and search are the engines, then digital has kind of been the soft spot.
Yeah, that's fair. Digital revenue was down 2% overall. That was driven by weakness in project work, even though subscription revenue actually grew 5%.
And management was pretty candid about this, weren't they?
Very. They basically admitted that their sales approach wasn't working. So they took some pretty aggressive action. They cut the digital sales force by about 35%.
Wow, that's a huge cut. Seems risky. What's the goal?
The goal is quality over quantity, again. They're getting rid of the product specialists and bringing in sophisticated enterprise sellers who can pitch these huge multi-year subscription contracts.
Sacrificing some short-term revenue for long-term consistency.
And for high-margin subscription growth. At the heart of that whole strategy is the brand new Talent Suite.
Okay, we need to spend a minute on this because it feels like this is the key to monetizing all their data.
It absolutely is. The Talent Suite is an AI-enabled platform. It's designed to unify all of Korn Ferry's core IP, their data on assessments, pay, learning, all of it.
So instead of a client buying different pieces from different silos, it all flows together now.
Precisely. A client can assess an employee, and the system automatically cross-references that with KFY's benchmarks to deliver personalized development content. That level of data integration is a huge competitive advantage.
So where's the multi-billion-dollar opportunity here? What justifies that big Salesforce pivot?
It's all about regulation, specifically pay transparency and pay equity laws.
We're seeing this everywhere, but especially in the EU.
Exactly. In the EU, companies over 250 employees have to make these detailed disclosures on pay gaps. To do that, you have to combine job architecture, what a job is, with precise pay data.
And Korn Ferry owns massive data sets on both sides of that equation.
And the Talent Suite is explicitly designed to solve that compliance problem. It's an integrated solution that's very, very hard for competitors to replicate. This is a massive opportunity for them.
Let's touch on AI more broadly. Management's view is that it's an augmentation tool, not a replacement.
Right. They see it having the biggest impact in RPO right now in sourcing candidates. Using tools like their KF Nimble Recruit, it just makes high-volume hiring much more efficient.
But for executive search, it's still all about the human relationship.
For now, yes. AI helps with admin, but it's not replacing that high-touch consultation.
Got it. Let's look quickly at the geographic picture because there was a big divergence.
A stark contrast, really. EMA, that's Europe, the Middle East, and Africa, was on fire, up 20% year over year.
Wow.
The Americas grew a more modest 3%. But APAC, Asia Pacific, was flat.
Which is a bit of a concern.
It's hampered by macro headwinds there. It's definitely something to watch in the coming quarters.
Okay, so let's zoom back out. Put this in context for an investor. The stock jumps 4% on double volume. The market clearly liked the backlog and the cross-sell story.
They did, but if you pull the lens back, the stock is still lagging the S&P 500 over the last 3 and 12 months.
And that's where the skepticism lies, right?
It is. The market is still waiting for proof on two things. A real recovery in digital and APAC, and, whether this mid-single-digit growth is enough to justify a higher multiple.
What about the guidance for next quarter, Q3?
It's pretty typical for the holiday period. They're guiding to fee revenue between $680 and $694 million.
A sequential step down.
Which they attribute to seasonality, losing a couple weeks of billable time. Adjusted EPS guidance is between $1.19 and $1.25, which is pretty much in line with the street.
And capital allocation remains steady.
Yep. The dividend is steady at $0.48 per share, and they're still committed to buybacks. Very shareholder friendly.
So the narrative is a strong one. It's a durable, cash-generative business that's executing a pretty complex strategy really well.
And they're taking aggressive, calculated risks to fix the digital business, positioning themselves as a strategic partner, not just a staffing firm.
Okay. Now, before we wrap up, it's time for our high conviction, maybe slightly speculative segment.
Let's do it.
This is not financial advice segment.
All right. Based purely on this deep dive, here's a plausible trade idea. You go long, KFY. You're betting on a multiple re-rate.
Okay.
The safety net here is that massive $1.842 billion backlog. It's up 20%. It proves the strategy is working, and it really limits your downside risk.
But what's the catalyst? What makes the trade work?
The success hinges on them proving in the next 2 quarters that the new talent suite can grow enterprise subscription revenue faster than the old project work is declining.
So it's all about the digital inflection.
It's all about that.
Yeah.
The specific catalyst to watch for is the initial monetization of that huge EU pay transparency opportunity in the back half of fiscal 26. If they start landing those multi-million-dollar compliance deals.
Then the market will have to believe the digital turnaround is real.
Exactly. And that's when you get the multiple re-rate that closes the valuation gap to the broader market. It's a bet on backlog conversion meeting digital inflection.
A very specific and confident pitch. So, key takeaways for you today. A strong financial beat, the integrated Are Korn Ferry strategy is working, and the new talent suite is targeting a massive regulatory opportunity.
And here's a final provocative thought to leave you with. Given the stock is still lagging, what level of growth acceleration above these mid-single digits will it take for the market to finally fully price in the value of that record $1.84 billion backlog? When do they start getting treated like a consulting firm?
Great question. Fantastic analysis. Thanks for joining us for this in-depth exploration. We'll catch you next time.